What is petty cash? Petty cash is referred to as an amount of cash kept on the side to pay for minor expenditures such as office stationery, small mailings, or coffee for a meeting. The amount of petty cash each company has can vary from $30 to $300. There are three main components in the operation of a petty cash fund: establishing the fund, making payments from the fund, and replenishing the fund. Establishing the fund. The petty cash fund is established by writing a check for the amount of the fund, cashing the check, and placing the cash under the supervision and responsibility of a selected employee, which then a journal entry is made to record the establishment of the fund. For example, on the 1st of May, R&D's law firm cashes a $200 check to establish a petty cash fund and gives the cash to the selected employee named Dan. R&D law firm would then record the following entry. The entry increases petty cash and decreases cash, leaving no change in total assets. Making payments from the fund. Since the fund has been established, cash can be used to pay for appropriate expenditures. There are two ways for payments to be made. Cash can be taken from the fund or employees seek reimbursement from the fund. In R&D law firm's case, employee Dan should collect receipts and authorize any use of the cash. There are no journal entries made for payments through petty cash, only when the fund is replenished. Replenishing the fund. Dan discovers that there is only $5 left in the petty cash fund. Therefore, the fund must be replenished. To do so, the remaining amount is recorded and R&D law firm cashes a check of $155 that brings the original amount back to $200. When preparing to replenish the fund, Dan examines the petty cash fund for receipts that are used as documentation and prepares a report. The report shows $155 needs to be placed in the fund for it to be fully replenished, with receipts totaling to $155 as well. Dan would then cash a check of $155 and record the expenses as. The entry would increase the three expense accounts and decrease the cash account for the amount of the check. The entry reduces both assets and equity, and each time the fund is replenished, the same entry is repeated. Cash over and short. Sometimes the amount of cash needed for replenishment is not always equal to the total amount of receipts. Since the person in charge may not always receive the receipts or has given incorrect change, therefore there will be a discrepancy between the cash needed for replenishment and the amount of receipts. This amount will be charged to an account called cash over and short. This was the process of a petty cash fund.